Aaron Kennedy here today with Evan New and Jamal Carnett, and we're doing Tech Teardown for Friday, October 25th. In big news for Apple investors, Icahn has published a letter that he wrote to Tim Cook, outlining his previously mentioned $150 billion buyback in more detail. What are his arguments?
Really kind of reiterating a point he already made when he had dinner with Tim Cook earlier last month. But he's really just making a case for it, saying Apple really needs to aggressively pursue it, take advantage of a short-term opportunity because he thinks that right now it's kind of an anomaly how undervalued Apple is. Makes the case that Apple could take out $150 billion in debt, basically immediately go back and buy almost a third of the entire market cap, which would be immediately accretive to earnings. He also assumes that if Apple does this, they could actually reach as high as $1,250 per share within the next couple of years.
What advice would you give Apple here, Jamal?
Well, I actually wrote an article about this yesterday. I think the best advice to give to Apple is to just ignore Icahn. I'm all about a conversation between management and shareholders about capital allocation and various strategies. However, the conversation shouldn't be hijacked by somebody with an oversized megaphone. It seems a little unfair that he's able to take these large positions through options and then tweet and have these stock pops happen. I'm not really too impressed with the overall offer.
What do you think of the $150 billion buyback? Is it meaningful? Is it even possible?
I think $150 billion is extremely large. Regardless of if you go with that number or maybe something a little bit less, I think the important thing for shareholders is that if Apple does do a bigger buyback program and finance it with debt, the net effect is it reduces Apple's weighted average cost of capital because equity capital is much more expensive than debt capital. If you can swap it out, you're going to see a meaningful increase or decrease in the cost of capital overall.
All right, let's move on to our next story. Job networking site LinkedIn is moving on to bigger fish. Like other social media players these days, LinkedIn is now targeting mobile users. The company now expects over half of users to come from mobile devices next year. What's this mean for investors?
Well, so right now LinkedIn said that in the beginning of 2011, only 8% of its user base was using mobile devices. That number is now up to 38%. And this is important for the company because mobile users tend to be a lot more engaged. They're about 2.5 times more active. And that's a big opportunity for them to kind of increase engagement on mobile platforms, grow ad revenue. Sponsored updates on mobile are about 50% of the marketing business, which is 24% of the business. So I think there's a lot of upside.
What do you think is motivating this move?
Well, I think LinkedIn themselves admitted it. Mobile users are more engaged. It's important to understand the business model of LinkedIn. They're an advertising network, and they also have some other features. But what you want to do is you want to get users in, you want to keep them engaged, and then you want to deliver ads to them. LinkedIn's a little different because they have a talent solutions division that actually makes about half their revenue, and they also have a premium subscriptions division. However, all of these divisions will actually benefit from an engaged user base.
Do you think LinkedIn is a buy?
I think it's pretty expensive right now, but that's it's been expensive for a long time, and I think that people have kind of looked at that their earnings multiples and stayed away because of that, have potentially missed out on some of the run. I think LinkedIn has a lot of disruptive, transformative potential in the job market. I've been a shareholder for a while, and I think that they still have a lot of room to grow.
All right. Next up, T-Mobile is at it again, shaking things up in the wireless industry. The latest example is a promotion offering tablet users a small amount of data per month for free for life. What's T-Mobile's angle here? This sounds like an expensive proposition.
For them, maybe. They certainly want you to just basically go through that data and then buy more data. But I think that there's been a lot of evidence to show that tablet users today predominantly prefer Wi-Fi only models and aren't buying cellular models, which from a carrier's perspective, they want more people using cell models. But I think people don't really know how much they're going to use, and they look at that upfront premium, in Apple's case of $130 just to get the cellular option, and they don't want to pay that. And I think by T-Mobile is doing their financing plan, spreading out that cost over a period of time, but they really want you to understand. They want you to understand your own usage patterns better, and then hopefully buy up more data later.
T-Mobile's been doing a lot of new moves in the carrier industry. Do you like this?
I do. I think this is one of the more underreported stories of the tablet wars. T-Mobile's been aggressively targeting the majors with creative financing and also zero down policy. Actually, last quarter, I think the August quarter, they actually added 1.1 million net subscribers, and about 700,000 of those were actually contract. Compare that to the previous year's quarter where they actually lost about 500 or 600,000 subscribers. You can see T-Mobile's growing and becoming a disruptive force in the industry.
We've seen with the other big carriers, after T-Mobile unleashed its upgrade plans and stuff like that. Other carriers kind of followed suit. Do you think rivals will be doing the same here?
I don't actually. Right now, in the particular market segment of that 200 megabyte monthly allowance, there's not really a lot of other carriers that go there. AT&T has a 250 plan and it's $15, but Sprint and Verizon, their minimum plans are a gigabyte, so they're not really interested in moving that down to that really lower end of the market segment in terms of the data plans. And AT&T has said that it's not really going to do anything right now. It's going to basically stand pat on its plans, so it's not too concerned right now. So I think the larger carriers are pretty content staying at a little bit of a higher end of the market.
All right. The Verge is reporting that Amazon's set-top box is running into delays. Throughout the year, we've been hearing a lot about the set-top box, presumably called the Fire Tube. Meanwhile, Amazon just reported earnings and has skyrocketed to fresh all-time highs. Doesn't look like investors care much about these delays. Do you think they should?
No, I think that the set-top box has always been kind of one of those random offshoot storylines that's popped up. It's not going to be a core part of their business, and their earnings. Investors are pretty happy with the earnings last night, so they're not going to be overly worried about a delay in some side project, and I don't think they really need to be.
How do you feel about this product?
I'm actually taking a different stance here, and I'm looking at the overall big picture. Peter Lynch coined a term called diversification. That's when a company, in a attempt to get at revenue, decided to get into areas that weren't really their areas of focus and they weren't really good at. This delay makes me wonder about FireTube's relevance or FireTube's existence. In addition, they're looking to add content, so I don't know if they're really staying in their wheelhouse here. Like I said, and like Evan said, it's a very small part of their overall revenue projections, but I'm not really sure they know what's going on with this particular product.
So this is a pretty crowded market because you've got Google's Chromecast, Apple's TV set-top box. Why would Amazon be pursuing this? Because how are they going to stand out?
So I think that if you look at tablets, they use their Fire OS, which is a forked version of Android, and because of the way they modify it, they get a very limited subset of Android apps. I think the angle here is to really open up third-party app support, which could really differentiate it from other players, depending on when those other players embrace that. Because I think it's a definite when, not if. I think Apple will eventually embrace third-party apps on their TV platform. Google is starting to through Google Play. But if Amazon can get in there quickly, which again now we're talking about delays, but that would be the real angle here, is to really open up support to a wider range of content partners.
All right. Samsung is now being fined $340,000 by Taiwanese regulators after an investigation proved that Samsung hired students to post fake comments bashing their competitors. This seems like a pretty dirty trick. What's up with that?
Samsung has a history of sometimes using kind of dirty tricks. And not only have they had a lot of controversy over bribery and slush funds, but now that, here we have evidence that they've basically tried to undermine their rivals in kind of these kind of shady advertising methods. And I don't think it really adds a lot of confidence to Samsung's story as a respectable competitor that if they're resorting to low blows like this.
What do you think of this story?
Well, apparently some of these Samsung commenters must have found some of my articles as well. But going back to what Evan said, it really makes you question the overall truth and communications from the overall Samsung as a corporation. It seems a little insidious. We always want to think of comments as kind of the wild, wild west, but we always want to think of them as actually true. The fact that Samsung's doing this is a little disconcerting.
Can you think of any other examples? I feel like we kind of like to bash Samsung, but this is a pretty juvenile move. Can you think of any concrete, more real anti-competitive things that Samsung has done?
Another one that Samsung has been doing recently has been kind of, in a way, optimizing its processors and phones around specific benchmarks. For example, a lot of review sites will use benchmarks as a way to measure performance, and Samsung is basically artificially targeting these benchmarks in an effort to get much better scores, kind of gaming the system a little bit. Samsung's not actually alone. A lot of vendors do this because they know that there are a lot of common benchmarks, and hopefully consumers are going here and reading it. If they see higher benchmarks, might improve their chances of buying this product. But it's kind of it's not real indicative of real life performance. So it's kind of a shady move, another shady move there.
So Samsung has said that they've sold as much as 40 million of their Galaxy smartphones. What do you think? What do you think of that number?
That's a big number, 40 million, and this phone came out 6 months ago. So 40 million is a big number for any company that's not Apple, and that's far and away much higher than any other Android vendor could hope to sell. At the same time, growth is certainly slowing. They sold about 20 million in the first 2 months that hit 30 million after 4 months, and I think they only reported they shipped about 5 million in August. So we're seeing growth starting to slow as this product is aging.
Should Samsung's competition be worried about this? That's a pretty big number.
That is a pretty big number. If you put it in perspective, though, Apple sold about 90 million of the iPhone 5, and of course that's the real big competitor here. So the competitors within the Android space should be worried, and also Google should be worried as well, because that gives Samsung an oversized voice in communications or in negotiations with the Android models.
The company also just reported earnings. What did you make of those numbers?
So what we're seeing is, like we mentioned, smartphone growth is starting to slow a lot. Some of the more recent products probably aren't going to be hits, like Galaxy Gear, Galaxy Round, in part because they're very targeted markets, and the Round is only going to be released in Korea, so it's not like a wide appeal type of device. That being said, their memory...
The Round is also like $1,000, right?
And it's a curved smartphone,
I mean, $1,000 phone, I don't think that's going to happen.
But it's curved, don't you?
Ooh.
But the memory chip business is really coming back in a big way, in part because of that fire last month at SK Hynix, the competitor, has really driven up DRAM prices, and that's really helping competitors like Micron, Samsung, really boost their own margins. And I think that's Samsung's expecting that strength to continue.
All right. Let's look at the social media space now. Earlier this month, Twitter made its S1 public for investors to see. After digging through the financials, the biggest question left was the price. Twitter just announced that it's pricing at $17 to $20. What do you think?
I think it seems like a pretty reasonable price for the potential that Twitter represents. Of course, a lot of it still remains to be seen, but I'm pretty interested at this price. I mean, I'm probably not going to get in at the IPO because I think there's a good chance it'll pull back a little bit. But from that starting point, I'm definitely interested, considering where I think Twitter can grow to if it can reach the size of its rivals.
Do you like Twitter as an investment? Are you interested in that?
I am interested in that. I think the pricing reflects an overall departure from Facebook. I don't think they want anything to do with Facebook's disastrous rollout. But if you look at it, it's priced 1/10 the price of actual Facebook stock. And it has about 1/5 of the user base. So looking at that, you would think that it may be a little underpriced, all other things considered.
Now, I'm wondering if there isn't a bubble happening here. I heard on the radio this morning that Pinterest is being valued at close to $4 billion. Pinterest. So, are you nervous for Twitter? Do you think things are getting a little heated up? I mean, LinkedIn, Facebook, both at all-time highs. Twitter's going to come out. Do you like this space? Well,
I think Twitter is actually pricing relatively conservative relative to some of the larger rivals. Like Jamal said, it's much smaller in terms of valuation. But even at $20 per share, which that range can still change up until they actually go public. But at $20 per share, they're actually less than what they valued themselves at in the internal private markets last month at $20.62. So I am kind of curious of why they're actually pulling that back a little bit. But at the same time, that's pretty conservative in my mind, and I think that the valuation is compelling compared to rivals. They're at the high end, they're at 21 times sales. Facebook went public at 24 times sales.
All right, let's cruise through some earnings. Several companies released earnings results recently. Earlier this week, Icahn got crushed after reporting, and fourth quarter guidance was the culprit. How bad were the figures?
So the current quarter wasn't too bad. Revenue of $396 million, adjusted earnings per share of 50 cents. But like you said, outlook was really where investors were concerned. Companies guiding to 412 to 430 million, which is below the street's consensus at 423.
So Icahn also said that it was in negotiations with its largest media customer. Who do you think that is, and how much does that affect Icahn?
So that's probably referring to either Netflix or Apple. I think the shares sold off a lot, and I think it's kind of an overreaction because Icahn said that they're in negotiations. It's not like they're losing this deal, and it's really coming down to price. And Icahn doesn't have any 10% customers, so even this largest customer is not a huge over 10% of sales. So if they're pushing this deal out to Q4 or Q1, it's still going to happen, it seems like. And I think that, on one hand, it does reduce visibility into the media business, but, when you come back to it, they're only, the revenue outlook is down. It's just a little bit below consensus, and it's just a pricing negotiation that people are freaking out about. I don't think it's warranted here.
All right. Microsoft reported earnings Thursday evening, and shares actually jumped in after-hours trading. How did Microsoft's third quarter turn out?
It actually turned out a very good quarter for Microsoft. It appears they had a healthy beat of 8 cents on expected revenue, or better than expected revenue of about $18.5 billion. The really standout performer here was the actual hardware, devices and consumer hardware segment, which includes the Surface. It was actually 40% higher than last year's total. So it appears that Steve Ballmer's, the camel that broke the straw's back, may be actually coming back to be a revenue producer for this company.
Microsoft attributed much of its growth to enterprise customers. If you were a Microsoft investor, are you happy about that, or are you more nervous that they're not getting more growth from regular consumers?
You are. Besides this was a standout. This was a standout figure as well. But you're right. A lot of growth comes from enterprise, and you're looking to actually grow outside of that, particularly with the consumer. So you're a little nervous there. However, I think overall you saw investors were pretty related with the performance this quarter.
Let's look at another company that recently reported Fusion.io saw shares decimated after earnings. What's going on with the flash specialist?
So it's kind of like what happened with Akamai. Fusion.io, the current quarter, came out above consensus, revenue of $86.3 million, adjusted loss of 7 cents per share. Again, guidance was really the issue here, because they said they expect revenue in the next quarter to be up slightly sequentially, which doesn't really compare well to the street forecast of $114 million. On top of that, CFO Dennis Wolf is leaving, Chief Sales Officer James Dawson leaving. We have a lot of high-level execs,
Jumping ship.
Departing doesn't add a lot of confidence, adds uncertainty.
So Fusion.io went public just 2 years ago, and it's really down from its IPO price. Why do you think this story got so dark so quickly?
So they went public at about $19 a share, and at the time, they were really heralded as really an innovative approach to putting flash storage in these storage arrays. And since then, earlier this year, co-founder David Flynn left the company, and now former HP exec Shane Robinson has come and take over. He said he's been working on kind of fixing some of the problems of his predecessor, but also Fusion.io was also seen as something as a possible takeout candidate. But instead, what we're seeing now is larger rivals that would have been the acquirers are instead just choosing to compete. For example, last year EMC launched VF Cached, which really competes. And so I think the idea of them getting bought out by someone is kind of starting to lose its luster.
All right, and in our final earnings story, Apple will be reporting earnings on Monday. What can investors expect?
So the big storyline here, of course, is going to be iPhones, like it always is. But the September quarter is generally one of Apple's slowest. If you look at historical context, last year they actually did very well with iPhone units. They sold 27 million in the previous year, which was a sequential increase, which is notable because everyone expects iPhone upgrades. It's so widely publicized that you would think that there would be a slowdown heading into their launch. But last year we actually saw an increase. So the big question, with the quarter that they're about to report is, can they do the same thing? The iPhone had about, the new ones had about 10 days or so that they're going to be on in this quarter.
Jamal, what are you looking for in this earnings report? I'm
looking for the number 37. Apple earlier gave estimates of $37 billion in revenue and 37% gross margins. The 37% is on the high end of their range, has been on the high end of their range for the last couple of years. So it's important to look at that, but I do believe they're going to guide for the upper end of their estimates and also the upper end of their margins.
Is there anything that you would like to see in the earnings report, particularly a particular number or a benchmark? What do you want to see Apple hit?
Well, I think Street's probably looking for 25 to 30 million. Last quarter, actually, I think they might need to do higher than that to really impress investors. Because last quarter they did about 31.2 million, and like we were just talking about, if they can hopefully get a sequential increase, that would be a really nice surprise for investors. But it's going to be pretty tough.
All right, that's all for today on Tech Teardown. Do you want to learn more about the tech stocks we're investing in? Just send an email to tvwar@fool.com and you'll receive our special free report on the $1 trillion battle for your living room. For Evan New and Jamal Carnett, I'm Erin Kennedy, and we'll see you next time.